Hello and welcome to our fourth quarter market review and update. I am Jason Gunkel and I lead our investment team here at Severson Strege. And we have a special guest this quarter, Lance Gunkel, our managing director. Lance, thanks for being here.
Of course.
I can't believe it is the end of the year already. It has flown by, but we're going to take a look today at the full year in review. And luckily, it has been a good year in the markets. And so all asset classes, nearly all asset classes are up this year. The U.S. stock market is up close to 18%. And the international markets have really led the way this year, up over 30% in both the developed countries and the emerging market countries. Real estate has done okay this year, up close to 8%. And then the bond market has also done well this year. So taxable bonds are up over 7%. Municipal bonds are up over 5%. I should also mention gold because I've had a lot of clients mention gold to me this year. Gold is up over 65%, reaching near record highs. And a few reasons for that. Some of the market volatility early in the year caused a lot of people to jump to gold. And then also a lot of the emerging market nations are buying up more gold as a reserve instead of buying the US dollar. And Bitcoin, for what it's worth, is down this year. It's been a volatile year this year for Bitcoin, but it has ended the year down so far. And I should say, we are recording this about a week before the end of the year, so things could change a bit. And as we look at some of the major market headlines for the year, so early in the year there was more volatility. It seems like a lifetime ago, but from peak to trough, the market was down. It hit a bottom on April 8th. It was down 19%. Which is kind of hard to go back and remember that. And then on April 9th, the following day, after some of the tariffs were postponed, the market rebounded 9.5% in one day. So it's a good reminder to our investors to stay invested in the market because things can change a lot even in one day. So the market focus really started the year on tariffs. That subsided, and still a lot to be worked out with tariffs. A lot of them have been lowered, and some of them are still going through the courts determining what is legal or not. But a lot of those fears have been eased in that those tariff levels should be lower than initially feared. And now the market focus seems to be on artificial intelligence, the earnings of those AI companies. And also people are paying close attention now to what the Fed is doing and if they're going to lower interest rates any further. So Lance, do you want to take us in a little bit deeper as we look at some of the various parts of the stock market and what has performed the best this year?
Yeah, you bet. If we look at the different asset classes, you mentioned international stocks, and I think the return of international stocks has been one of the major stories this year. And of course, a declining US dollar has acted as a tailwind helping international stocks from an overall return perspective. The graphic we're showing has returns through August. And if we update our figures through December 19th, the international stock market measured by the MSCI World Index is up a little bit over 30%. And if we look at that same index, but in local currency terms, it's up about 21%. So you can see the difference there is the result of the currency effect. So moving those dollars from foreign currency into US dollar terms picks up close to 10%. So this is, I think, a good example of why we diversify globally, because we can't predict currency moves, but different environments reward different markets. We can also take a look at the returns of different styles, so value investing versus growth investing. And return leadership has rotated between growth and value styles throughout the course of the year. Growth excelled during the second quarter, and then we saw value do quite well during the third quarter. And again, through December 19th, we see that growth is leading the way again. Large growth stocks are up an average of 19%, and large value are up an average of 15%. So another reminder, no style stays on top forever. Another reason why we like diversified investment allocations. Taking a look at value and growth stocks again and valuation. At the beginning of the year, Morningstar's equity team looked at market valuation, and their estimates showed that as a whole, the market looked about fairly valued, but that growth was generally overvalued. Value stocks were undervalued. Then, you mentioned in April we had news of tariffs hitting, and that caused a significant market decline. At that time, Morningstar estimated that every segment of the market was undervalued. Now, since that April time, markets have rebounded substantially. And from a valuation perspective, today we're about where we started the year, where growth looks a little overvalued and value is a little undervalued. So, speaking of valuations and returns, what happened to the big Magnificent Seven this year?
Yes, as they call them, the Magnificent Seven, the seven largest stocks and tech stocks in the market. So let's see if I can get them here. Facebook, Apple, Amazon, Microsoft, Google, Tesla, and NVIDIA, I think is the one I missed, and NVIDIA now the largest. But if you look at the concentration of just those stocks, those seven companies make up close to 40% of the entire S&P 500 stock index. So a very high level of concentration. You have to go back to 1970, where we had a similar amount of concentration. Of course, the market looked a lot different then. The top companies, I had to look this up, but maybe I could have guessed some of them. AT&T, General Motors, Ford, Standard Oil, which is now Exxon. So a lot of oil and industrial type companies, now dominated by tech stocks. But those stocks, volatile through much of the year, and some mixed performance among them, but they ended the year strong, and as a whole are up about 23% year to date, so beating the overall market. So we've had a lot of clients ask, and I've seen some headlines as well in the Wall Street Journal and other places, are we in an AI bubble? So they're trying to compare this time period to the dot-com era of the late 90s and ask, are they similar? How did the valuation of the market look? And if you look at this chart here, this really gives a good idea of the difference between then and now. So in the late 90s, or this is actually March of 2000, it shows the NASDAQ stock index, and the NASDAQ is dominated by tech stocks. So when we speak of tech stocks, most people look at the NASDAQ. That PE multiple, the price to earnings multiple, was over 200. So very, very highly priced. And right now, still looks a little highly priced, but it's about 50. So not anywhere near where it was back in 2000. And so we typically answer that question as we don't think we're in a bubble right now, or even the tech stocks are in a bubble. But we do think things are starting to look a little bit expensive. And if you look at this chart here, this looks at the PE multiples across the entire market. And it shows the trailing 12-month PE is about 27.5 compared to an average of around 20 over the last 5 or 10 years. So it looks like that seems kind of expensive. However, if we look forward and the next 12 months, earnings are expected to go up by another 15%. And if they meet those expectations, the PE multiple could fall back to around 22. So things are looking a little expensive, not in bubble territory, and this type of valuation could continue for a while. We've seen it continue for a while in the markets where things look a little bit pricey. And just going back to those earnings expectations, as we headed into this year, people had some pretty high expectations for earnings this year. We'd have double-digit earnings growth in the S&P 500. And for the most part, companies have met those expectations. We've had about a 12% growth rate in earnings this year. And then next year, I mentioned there's a 15% expectation. And that would make 3 years in a row with double-digit earnings growth. So a really good market continues, the bull market continues, but it's so far earnings have justified the market going up. Well, Lance, why don't we shift gears a little bit and talk about the bond market. Do you want to give us a little summary of how the bond market has fared this year?
Sure. Coming into this year, we had a period of rising interest rates. And in a rising rate environment, that tends to be difficult for bonds. They see lower prices as a result. But this year, we saw that bonds have delivered more stable results. So, added on to those higher yields, they've been kind of restored as both an income generator and a portfolio stabilizer. So they're once again contributing in a meaningful way to a diversified portfolio. So for example, if we look at some bond index returns, the Barclays Aggregate, which is kind of the primary bond index, it's up about 7.1% year to date. The Barclays U.S. Treasury 3 to 10 year index up 7.4%. The Barclays U.S. Corporate Bond Index up again 7.4%. And last but not least, the Bloomberg U.S. High Yield Index up 8.2%. So pretty strong returns from different segments of the bond market. And those prices rose because bond yields have come down from recent highs. So while yields may fluctuate year to year, month to month, I think we agree that bonds remain an important tool for managing risk and volatility. So, Jason, maybe now we can shift our focus to the economy. What do some of the economic indicators show, such as unemployment, inflation, and GDP?
Sure. We got a reading on unemployment recently, and the November results showed it was unexpectedly high. It jumped to about a 4.6%, which is the highest it's been in 4 years. And so most of that, from what I've read, is that it seems like employers are not doing much new hiring. They might not be laying off people. Some companies you've seen some layoffs, but for the most part, there's been kind of a hiring freeze. And that might be due to just some uncertainty that they're feeling in the economy and just not wanting to maybe add employees at this time to keep costs down. And then also, I've read some articles about how AI might be coming in and taking some jobs as well. On the inflation front, we got an inflation reading for November as well, and that was better news. Inflation actually dropped a little bit, down to 2.7%. It had been rising and had reached 3%, so it's good to see those inflation numbers staying in check. A lot of question marks throughout the year of how tariffs were going to affect inflation, and so far, inflation has remained in check. And then as we look at GDP growth, so just overall economic growth, some good readings for the second quarter. It was about 3.8%. The quarter three numbers were delayed a little bit. They're actually going to come out tomorrow, so we don't have those yet as we record this, but still expected to be over 3%. And as we look ahead to next year, though, the consensus among economists is that economic growth is going to slow. And maybe they're just being conservative, but those numbers are expected to go down. And maybe that's due to some of the rising employment numbers, some rising inflation numbers, keeping consumer spending down. So we'll see, but economists not as optimistic about next year. So Lance, as we look at those three readings on the economy, what is the expectation of what the Fed is going to do next year?
Yeah, we've had 3 rate cuts in 2025. And the graphic we're showing on the screen indicates that estimates are thinking that there could be 1 rate cut in 2026 and then 1 additional rate cut in 2027. But there's still a lot of uncertainty around if and when the Fed will cut rates. And we know that timing interest rate changes is extremely difficult. I think rather than guessing, our focus is instead on building resilient portfolios that can withstand any type of scenario. Historically, bonds tend to perform better when interest rates begin to be cut. But the experience isn't always smooth or predictable, and it can really vary across different segments of the bond market, which is shown in the graphic on the screen now. And this is another reason why bonds can play a supporting but not a speculative role in portfolios. And then if we look at what happens to longer-term bonds during periods of interest rates, we see that they don't always outperform during those periods, which may be a little surprising. But the chart on the screen shows returns when the Fed pauses interest rate cuts. And we see that returns vary. The periods that are shown in red indicate times of higher rates and lower prices despite these rate cuts. So diversifying across bond types and duration can help manage that risk. So Jason, as we put a bow on 2025 and we ring in 2026, what is your outlook?
Yes, well, this graphic here shows some of the positives and risks for the market and the economy. And I guess if it were a scale, it might be fairly well balanced. I still maybe would tilt towards the positive. I think we've got still some positive momentum as we head into 2026. And some of those positives we've mentioned, the Fed cutting rates, and I guess we didn't mention yet the new tax bill that we got earlier this year that kept tax rates lower. So that's providing some fiscal stimulus. And then also corporate profits remaining strong. And as long as profits are strong, I really would expect the market to continue doing well. On the risk side of things, those unemployment numbers are probably the most concerning thing. And hopefully unemployment doesn't keep rising, which would ultimately affect consumer spending, which would ultimately affect those earnings from companies. Inflation, we want inflation to remain in check. And then, of course, we want earnings. The expectations for earnings are pretty high, and they're going to need to meet those relatively high expectations as well. So the implications for our portfolios, we're maintaining diversification. So we showed that graphic earlier where if you just buy a straight market index, you're pretty heavily concentrated into those top 7 companies. We want to own those 7 companies, but we also want to be more diversified than that. And Lance, you showed that graphic earlier where it seems like the value-oriented companies, maybe small to mid-sized companies, are showing more attractive right now. And so that's where we're going to be tilting our portfolios as well. And on the bond side of things, short to intermediate term bonds seem to be the sweet spot to take advantage of some of those rates being dropped. and trying to stay away from things longer duration, 10 years and above, which tend to be riskier. Also want to remind people that we've had a few good years in the market now. It could be a time to look at your portfolios and do some rebalancing, and just making sure you're at where you want to be between stocks and bonds. And if your stocks have gotten a little bit heavy now, it's maybe a time to take some gains off the table and just trim them back to your target levels. Also, as you look ahead in 2026 into what your expenses will be, we always try to have our next 12 months of expenses or distributions from our portfolio set aside in cash. And then our overall strategy between stocks and bonds is having at least 3 to 5 years of those distributions in bonds or something safe. So if we go through a market downturn, you don't have to draw upon your stocks. So just some reminders there as we head into the new year. And I think that might sum it up. Yes. So it's been a good year, and we can also hope that 2026 is a good year as well. Thank you for your continued trust in us. Thanks for joining us, Lance. We want to wish everyone happy holidays and a happy new year.